My name is Gul. I'm the founder CEO at Metal. Started the company about a couple of years ago. We've been in stealth. We launched on October 1st, 2025, and we are backed by Y Combinator and Andreessen Horowitz and a bunch of other early stage investors that we've been very excited to work through. As most of the people here are aware, we are building the capital formation platform for private markets, and our first product is a fundraising product that is being used by thousands of founders across the globe, particularly in the US. Today, we have here Charles Hudson from Precursor VC, and we have Matt Toms from Baukunst. Super excited to have Charles and Matt here. Across the board, Charles and Matt have they've spent decades in venture capital. Charles teaches at Stanford and this has made hundreds of investments. He's raised 5 venture funds. So I'll actually invite Charles to introduce himself and Precursor VC, and then we'll move over to Matt. And then after introductions, we'll get into a discussion on rooting into investor conversations and rejections. So over to you, Charles.
Well, thank you, Usman. I'm Charles Hudson, founder and managing partner at Precursor Ventures. We are based in San Francisco, California. We invest in 30 to 40 pre-seed and seed stage companies every year with a typical check of 250 to 500K. We are totally generalist. We will do a little bit of everything. I'm the founder and managing partner. We've got a team of 14 great folks here, and I'm really honored to be a part of this webinar. So thank you for having me.
Awesome. Thank you, Charles. Great introduction, and really excited for the conversation. I've always had this conversation, with founders and how to manage investor rejections, which is just terrific to sort of see the other side of the table and see how people think about that from the other side. Over to you, Matt. So Matt has been, he's one of the GPs at Baukunst, and he's been in venture for a while. Baukunst is it's actually one of the larger and more established brands in Silicon Valley when it comes to pre-seed and early stage investments. Matt, I'll pause there and I'll let you introduce yourself in your own words.
Yeah, sure. Thanks for having me. So I'm Matt. I'm a founder and general partner at Baukunst. We started the firm about 3.5, 4 years ago now. $100 million fund, and all we do is pre-seed. So we love writing founders the very first check. We lead almost every round that we do with checks from $500,000 to $2 million. And we invest at the intersection of technology and design. So really everything from on the enterprise side, software for how things are designed and built, manufacturing, supply chain, industrial design, all the way through to consumer goods, consumer marketplaces, and a pretty broad portfolio there. So we're half the team here in Cambridge, Massachusetts, the other half in San Francisco.
Awesome. Thank you, Matt. Great introduction. So with that, we will dive right in. Today, we want to talk about, one of these experiences that I think a lot of founders really understand, have thought through, and then also an experience that everyone goes through, but a lot of people may not have thought through. And that experience is, you speak with the VC firm, you sort of, do the things that you need to do to sort of explain what you're trying to build, talk about your vision, and you're excited and they're excited, and then a week or two passes by and they send you this amazing email. It's full of praises and positive feedback and positive reinforcement, but the end message is we're not going to move forward with an investment. And and you're confused sometimes, or sometimes you're not confused because you were sort of expecting that. In my experience, I raised 120 million for my first startup back in 2019, and saw tons and tons of rejections. A lot of them were surprises, a lot of them were not surprises. But the first thing we'll start the conversation with, maybe Charles, with you, is like, out of all your investments, right? What percentage of investments that you make in a given year are in founders that you have previously turned down? Or you've previously evaluated and have said no to an investment decision?
Just to clarify, if it's I said no to the original idea and they came back with the same idea, it's probably 0. If I said no to the original idea and they came back with a new company or a new idea, it's maybe like a couple times a year, so call it 5%. So it does happen. I do think sometimes I would just say, like, sometimes when you say no as an investor, there's like 9 reasons you're saying no, but you're not going to send someone an email with 9 no's. So you pick one. And so sometimes people come back and say, I solved the thing that you said no about. You're like, well, there were 8 other ones that we didn't get into. So congratulations for slaying that demon, but there are more things behind it.
Right, absolutely. And we'll come back to that in just a moment because I think it's a really important and interesting point that you highlight, Charles. So we'll come back. Matt, from your experience and perspective, of all the companies you invest in a given year, roughly speaking, an average, what percentage are founders of companies that you've previously said no to?
It's also very rare, I would say. I think I can think of maybe, and just to like put it into perspective a little bit as well, like for every company we do invest in, we took probably second meetings with like 100 other companies and probably, maybe 1,000 companies before that. So it's a very steep funnel to go from, what comes into what we actually invest in. I can think of maybe 2 companies over the past decade and 100 plus investments we've made where we said no originally and then later on invested. So like it does happen. It's very rare. I think as Charles mentioned, like one came back to us with a totally different idea and we liked the team. Another we weren't sure about the idea, but the more we thought about it and some market things happened that it became a little more compelling over time. But yeah, there's a lot more to kind of dig into on the how we pass in the pass process. So I would say it's very rare, but I still think there's a lot you can learn from some of those experiences.
I just realized in a hilarious irony, one of the companies that this happened with is one that Matt and I are in together.
No,
It is the
oh,
company
geez.
that I passed on when Kate introduced me to it the first time. I didn't quite get it. So I didn't do the pre-seed, but I did the seed when it came back around.
There you go. Love that.
Yeah, and just to double down on what Charles just mentioned, right? So I was part of the early team at DoorDash, and when DoorDash first went to Sequoia to raise a seed round, they said no. And then 6 months later, they led the seed round, and that turned out to be a legendary partnership. But what changed in those 6 months was the sheer progress the company had made from the first time Sequoia ran into DoorDash, and 6 months later. For Y Combinator, as an example, about a majority, more than 50% of their investments are in companies that they've rejected before. A very different model, very different structure, high volume accelerator model, like very, very different. But then, for a lot of like funds that lead rounds, right? Like I think this is actually very representative of, a lot of lead investors. If they say no, like they're probably not, it's very rare that they would, invest, but it does happen. And, would love to go deeper into what happens when that happens, right? Or what set of circumstances lead you to, not only reconsider a company you've already rejected, but also invest in that. So in the 5% of scenarios, Charles, or in the, rare occasions, Matt, that does happen, like what happened? What changed? Was it your perspective? Was it your own research? Was it something about the company?
I'll say there's 2 things that I typically see. One is macro. Like there's usually like something in the ecosystem that changed. It could be a new technology development, it could be a law, it could be a behavior that like wasn't present when the company met me the first time, but felt like necessary for it to be true. The other thing is sometimes I meet people and the thing that are described to me, it just feels very fuzzy. And I'm like, there's like maybe something in here, but like the way you talk about it and the language you use, it's just not clear. And they'll come back to me later and just say, oh, we realized when we saw you last night it was fuzzy. We've been working on this. We have a much sharper understanding of who our customer is and the product we want to build for them. And I'm like, oh, well, that thing sounds interesting. The thing you pitched me the first time didn't. And so it's always hard to know, like, is this a bad idea or is this a good idea that's just being poorly presented? And so sometimes that does happen.
I will also say too, I think the stage at which that Charles and I invested pre-seed is very unique for this question. Like I think if you're a Series A fund or even a seed fund, you can get really turned around by a lot of traction, right? A lot of market traction, good revenue, good metrics. Like we assume no traction. We don't need traction to invest, right? And oftentimes we don't have it. So it really changes the signal we're looking for. I mean, it's very rare at pre-seed that you have like knock your socks off traction, or that you pitch us with no traction, you come back and there's all this, you're going from 0 to 1 million revenue, maybe 2 million revenue, there's not enough to really say, oh my God, this is like, we got it wrong, we need to invest here. What we're much more looking for is like founder profile, right? Is this someone who's uniquely qualified in the top 1% of people who can build a company in this category? And that doesn't mean the most experienced or the most tenured, but it does mean the most passionate or most hungry, or who has that kind of like history of excellence in their track record. And then the other thing we're looking for is market, and sometimes we're um, not convinced it's a good enough market for a venture scale outcome. And that can, as Charles alluded to, things can change that start to give us some pieces to build that hypothesis. Um, but but the founder piece for us can be tougher to get to turn around on, right? You form an opinion of someone and it takes a lot to kind of overcome that first impression.
Yeah. And just on that note, Matt, have there been instances in your, time in venture where you evaluate a company and you're like, wow, like, I'm really not sure about this founder, I'm not, and then next call, you're like, wow, this is legendary. We need to be in. Like, has that ever happened? Where you've just like completely
Usually
pivoted?
not, because you usually don't take that second call if the first call is not great. We have the opposite happen where the first call is like honeymoon period, and the second call is a little rocky, and sometimes we'll try and power through that. Um, I mean, maybe if we get a really strong intro from one of the other founders in our portfolio and they say, hey, the first meeting was a little rocky, you have to, but it's pretty rare. I mean, it's very crucial for that first meeting to be, I think, a good experience on both ends, because we're really going from first meeting, second meeting is really the step where we like decide to spend a lot of time on it and really kind of prioritize it in our funnel.
Right. Just, prompts the question, like, what are things that you have, in the first call, like this is a 20-minute call, and maybe Charles, I'll come to you for that. Like, what are things that you find super impressive about founders that you end up investing in? Is it clarity of thought? Is it communication? Is it articulation? Is it the enormity of the vision? Is it, what are like common things that, you're that leave you with a very positive impression of the founder, independent of the idea, right?
Yeah, I think there's just as like a general framework, usually what I'm trying to figure out in a first meeting is a couple simple questions. What is this company building? Like, what does the product actually do? Why does this product matter to their customer? And the third thing, which is probably the most nuanced, is how did the person who's building this come to acquire the knowledge that they have about this problem? And I would say broadly on that last question, people fall into two different archetypes, and I tend to handle the meetings differently. One is like the industry insider who's building something in a category where they have a lot of context. Then I'm usually trying to figure out, okay, well, like how much of the context that this person knows is good, and are they maybe trapped by their knowledge of the way that the industry works? Is it going to limit their ability to be creative? And then we have what we call like the naive optimist, which is the outsider looking in. And I'm like, those people oftentimes have very different ideas for how to tackle problems. Sometimes the things they want to do are literally like impossible. So you have to kind of poke on those. But honestly, Usman, I feel like this is maybe an exaggeration, but not off by much. I feel like half of the pitches I take, 10 minutes in, I'm like, I still don't actually know what this company does. Yes, I see the AI harness, eval. There's a lot of words, but if I said like, what is this company's business and like, what are they doing? I think half the time, 10 minutes in, I'm like, I'm still not clear on what this company is. And if you're that far into a 30-minute meeting and I still don't get it, the probability of you turning the meeting around at that point is very, very low.
Excellent point. I love that. So, it's in the importance of extremely clear communication, which is often preceded by clarity of thought, on exactly what you want to build. And that may change, and that's fine. But, I think having that sort of clarity and precision is great. Matt, over to you. What are like the best founder conversations you've had, the instances you've had where you're like look, we need to invest in this founder, irrespective of the idea, and regardless of whether or not you ended up investing, like, what are things founders do that you're like that leave you thinking, wow, like this was a great conversation. I want to talk to this founder again.
Yeah, there's a lot of answers to that question. I mean, there's probably like a dozen or two dozen different kind of like archetypes that we find interesting for one reason or another. I think maybe to just single out two things that like of many that will perk up my ears is like we love seeing some history of excellence in some field. And it's not always, as Charles alluded to, sometimes it's they have certain domain expertise and they're pitching, that's great. But other times it's like, in school they were an Olympic skier or they had some area where they were like the number one or the top 1% in some area. And it just shows that level of ambition and drive that's a great proxy for us, even if they're earlier in their career, that they really have the motivation and kind of tenacity to become the top of their field. And that's one we love to hear. I also really just love to hear, and again, sometimes this comes from people who really know their industry well. Sometimes it comes from people who are newer to it and figuring it out, but really kind of boiling down the kind of essence of how that industry operates and using that to kind of project what they think it's going to look like in 10 years, and that takes a lot of both sincerity of like, okay, there's all these things going on, all these market dynamics, but here's really what matters. Here's who's influential. Here's what drives the most profitable incumbents in the space. Here's how we're going to change all that. And when we do it, it's going to look dramatically different. And for us also, like when we're looking at kind of market dynamics, like we just want to be able to squint and see a good market opportunity, right? Like if there's a big McKinsey report on why this is a great market, like it's too late for us as pre-seed investors. And we want to kind of see the early signal and early ambition that like, yeah, customers are starting to spend more than they did a couple of years ago, and there's more pain points and technologies and allowing people to be more efficient. And you really start to like plot those points that give you, okay, I can really see in 5 or 10 years how this market's going to be dramatically different. And this is the person who really understands kind of the fundamentals of how we're going to get there.
Right. No, that's great. And I mean, you're spot on, right? There's so many different things that founders do, or companies to come across. That it's a very broad list of things that can make a company or a founder stand out. I guess when you do pass, are there things you've seen outlier founders do differently in response to how they sort of go about rejections, right? Like trying to learn from that is one thing, but are there other practices like or maybe the reverse side of this is, Charles, like when your portfolio companies are going out to raise, what is your message to them? Like if they speak with 10 investors and 8 of them pass within 2 weeks of the first conversation, like what is how do you recommend and coach founders to sort of respond to or deal with rejections?
I tell them two things. One is, in some cases, most of the value in the no is the no. And like, that's like, don't lose, like, it was a no. And second, I'd say most VCs will tell you something that is true, but not necessarily the truth. And so, for example, I find it personally very difficult to have a conversation with someone about their team composition or like reservations I have about them as people, unless I'm invited to do so and I have like permission to like go into that topic. And if I don't think I have permission, I'm going to pick something else because that's like not something in my opinion, you can share with somebody unless they're open to that feedback. And I think sometimes you do get clusters of like feedback, but sometimes that clusters of feedback combined with the like true but not the truth means that people are identifying one really obvious glaring thing that's easy to use as the reason to say no, but that doesn't necessarily mean it's the core reason they're passing.
Right. Charles, that sentiment is so consistent with so many other things I've heard, from like if there's a no, you may, as a founder, you may likely never know why. And trying to read into that and trying to figure that out, right? It's just like not worth the time or the effort. It's probably useful to introspect and see, but I wouldn't, overthink it. And I think it's like spot on. Like, after one call, you don't have the sort of relationship, or the knowledge or the insight really, sort of share, personal observations on, X, Y, and Z. And so, yeah, that makes perfect sense. And then just in parallel with that, Matt, maybe we'll come to you. What are are there is there a shade of no which reads as like definitely no, whether it's an idea you don't like or the company or whatever, and then is there a shade of no which is like, look, I was really on the fence and I wanted to take the third call or the second call, but just like this is just like it was difficult to pass, but we ended up passing, right? And we remain curious on what happens here. And this was sort of right on the fence.
Um, it sort of depends. I guess I would answer that like the more time I'll spend with founders, like the deeper into diligence we get, usually the more feedback I'll share. Partially because we've like just developed more of a relationship, and I really, when I take people's time, I like to reciprocate in some fashion, and so if we've done more than 2 meetings, or I've had them talk with some of our advisors, or we've really dug into it, like I'll try and be more forthcoming with that. Um, and then, the earlier in the process, it's just tougher for us logistically, I think, to give a lot of feedback. I think there's not, if you're, talking to hundreds of companies, it becomes a little bit of a time and bandwidth issue. But in terms of, a hard no versus soft no, I mean, we're usually pretty definitive. Like, I think if there is an opening where we think that the founder's interesting, but maybe in the wrong market, or that they need some more time to iterate, we'll usually be pretty transparent about that and leave the door open. Because there's no real, I mean, and we accept that we might miss out on the round, or they might go to other investors or what have you, but there's really no benefit for us to shut that door unless we feel pretty definitive about it. So, again, with the handful of small exceptions, when we say no, it's usually pretty firm.
Right on. We'll take a quick before we continue. We'll take a quick question from the audience. We have some questions. I'll just nominate one question that I think is um, uh, that I think is very reflective of the audience here, particularly for pre-seed. So, the question is, as a founder pitching investors, how much time should a founder spend on market tailwinds problem if an investor isn't very learned on the market problem already? I'll just broaden the question a bit. So, maybe rephrase that as like, in a first investor call, what is the sequence of a great conversation look like? And do founders even have to talk about like things like, market tailwinds, those sort of things? And so, yeah, just some color on that. Maybe we'll start with you, Matt, and then we'll go to Charles.
Yeah, you definitely want to be prepared to talk about any of that. And I think it's totally fair game just to ask the investor. I mean, maybe they have a company in the portfolio, maybe they've gone deep in diligence on a company in a similar area, and they know more about it than might be obvious from having done research online. And that happens all the time. Like, and maybe that's why we took the meeting in the first place, is like, oh, we actually know more than you might think about this area, and we're kind of interested to learn. So I would just be upfront and say, is this an area you know much about? Happy to like talk through it, or happy to kind of fast track it. And I'll be pretty clear with folks, because if you only have, half an hour on a first call, like if I know the market, I'm not going to waste my time or their time like going through all the market dynamic stuff. I'll say, yeah, we can skip that unless I see something really interesting in the slide that I didn't know or that I want to get caught up on. So I would say just be prepared, but also like have it as a conversation, because I think a lot of investors also want to kind of get to the meat of it and not, hear things that they've already heard before.
Yeah, no, this is great. Charles, would also love to get your perspective on the first call.
Yeah, I just to double click on what Matt said, I personally get fidgety when someone like insists on walking me through a market where either I've made investments before or I've seen a lot of companies and I think I know it's very hard for me to sit still through that. I'm like, God, I only have 30 minutes. Like, why are we spending 4 minutes on stuff that So sometimes people will put up a slide and will just say, I agree with that. We don't have to talk about it. Yes, I agree that this is a big problem. Like we can skip this one. And just being flexible enough that like if you were dealing with someone who clearly has experience or has a point of view. And I think the best question, we've had a few cases where we've invested in categories where we lost money. And the person's been like, hey, what did you learn from that investment? In some cases, I'm just like, oh, it was the person or it was the timing or it was something else. But I do appreciate it when people give me space to like at least share what I learned. And if I were pitching, I'd want to know what that person thinks of the market before I went too far into the pitch.
Right. And I think the common theme here across the board is, read before you run, right? Like instead of coming in with a predetermined point of view on like all the things you want to talk about, like the more important question is like, what is the audience like? Where does the investor want to go? Like, what are they curious about, right? Like, where is their curiosity leading you? And if that's not leading you in the direction of the market, then maybe there's other areas. There's another really interesting question here that I really like this question. Question is, if a founder wants a decision in 3 weeks, what has to be true on day one for that to be possible? So
We
maybe,
make almost all our decisions in 3 weeks or less.
no, awesome. I guess, the spirit
Same.
of,
Ours are quick. I think in most cases, maybe the thing founders don't understand is oftentimes the amount of time I can spend on something new is directly proportional to the amount of other interesting stuff that I'm working on at the same time. And some of that stuff might be existing portfolio companies that are dealing with stuff that take priority. So sometimes, back to your question about advice I give founders is sometimes you're just like not the number one priority at that firm. And if it feels like it's going slow, it might not be that they're not interested in your company. It can also be that there's something else standing in front of you in line that's like consuming people's attention. And trying to tease out when that's the case is really important.
right, 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 right. And are there things founders can do to make the decision easier? And is there such a thing as being super prepared that just equips you and enables you to very quickly see that, hey, like this is, we have all the information we need to make a decision, regardless of whether, that's yes or no. Um, maybe Matt, maybe you're
Um, I mean, nothing really in particular. I mean, we always try and just like meet founders where they are, and if they've got a lot of material prepared, great. That's not always the case, and we're happy to kind of dive into messier things when it comes to operating plan or other things like that. We'll always do references both on book and off book. So if you're going out to fundraise, it's a good idea to like think of who you would proactively recommend as a personal reference and probably have a call with them to get them up to speed on what you're doing, and that's always something that we move into quickly. But from a materials perspective, um, there's a spectrum, but I think for the most part, folks come relatively prepared.
another,
Can I do a pet peeve, Usman,
please
for
do.
pitching and responding? So, and this was like a little bit in our prep questions as well. So one that I get a lot in past emails is asking if I can recommend other investors or introduce them to other investors who might be interested in what they're doing. And that's typically a terrible idea. And it's not terrible because I'm lazy or I don't want to make the intro or whatever. It's terrible because if I make an introduction or offer to make an introduction to another investor for a company I passed on, the first thing that investor is going to ask me is, are you investing? And when I say no, it's like dead on arrival. It's like, why did you even waste my time? So like, it may feel like, oh, we're looking for other intros or whatever, but the worst intro you can get is from an investor who passed on you. And maybe there's some exceptions if it's not, if someone's raising their Series A and we just do pre-seed, or they're in an area that we don't really spend time in but I'll usually offer that up if it's, if I think they're really, if I have someone in mind who's a good fit for them and it's just a stage or a sector mismatch. Um, but don't ask no's for other investor intros. Go find other investor in from great places like Metal, or go find them through other founders in their portfolio who you can network into to make an introduction. because it's just, it's a dead end pretty quickly if I try and do it. So
Yeah, no, absolutely. I mean, it's like, I invest in stocks all the time, but hey, Charles, you should invest in Apple stock. And if Charles asks like, hey, are you holding Apple? No, I'm not. I'm not gonna buy, but you should buy Apple.
yeah.
There's just it's just negative signaling yeah, totally see that. And a lot of first time founders are just doing this for the first time. I can see it not being obvious to people the first time around. But Charles, you mentioned something earlier in the conversation about ideas, and one, you know, um, I don't know if it's a fundamental truth or my opinion, but it's one of the two. Is that in this sort of nature of work, a lot of the most legendary ideas seem obvious in hindsight, but not so obvious in the moment. Airbnb, is a great example, right? Like so many other examples. And so, um, as you look at ideas of what someone wants to do, um, are there times when you get that wrong? And are there times where, and how much of your focus is like on idea versus founder, or is it sort of a combination because the idea is, an indication of what you think of the founder? How do you think about that?
We've gotten lots of things wrong, unfortunately. And I think a lot more actually about the sins of omission, the things we said no to because we didn't get it, than I do about the things we said yes to that didn't work out. And in most cases where there was, like, I'll give you one example. Like, we met the team at Whatnot. Like, one of the founders had been an early employee at one of my portfolio companies, and they explained the business to me, and I'm like, I just don't envision a world where this activity becomes as widespread and common as you do. And they appear to be right. I appear to be very wrong. But in most cases, I think all pitches are founders are trying to describe to me a future state of the world that generally doesn't exist. And usually in that future state of the world, like, they are the hero of the narrative. And in some cases, I'm like, yeah, I believe that version of the world will exist. And I think you're the right person to bring it to life. Then I'd say yes. Sometimes I'm just like, I believe that version of the future, but I think somebody else is better positioned to take advantage of it. And in many of my regrettable passes, I'm like, I just can't. Like, I remember being at YC Demo Day when Stripe presented, and everyone was like, developer payments. Like, this isn't even like, what do you tell you? This isn't a thing. And like, people just had a hard time imagining a world in which there would be lots and lots and lots of software developers who needed to integrate payments. And it feels obvious now. Airbnb, same way. We could name a dozen companies that now feel obvious that it certainly didn't. And I think whether it's luck, skill, or access, it doesn't really matter. If you get into those companies, you'll have a great run as a VC.
Right. Matt, any thoughts on the anti-portfolio? And I don't know if you guys. For the audience, the anti-portfolio concept is, VC firms tracking all the investments they did not make, that turned out to be great businesses, right? Or turned out not to be great businesses, and then just tracking the anti-portfolio alongside the portfolio to see, what that comparison looks like. Matt, any thoughts on idea versus founder? What's your focus? Do you prefer one over the other? I think there's vast variations in how pre-seed, investors look at those two. How much of focus is on idea versus founder? And so we'd love to hear your perspective.
Yeah, we always try and focus very heavily on the founder. I mean, ideally, it's like a good idea and a good founder. And in that instance, like, we assume that by the time they get to, say, 10 million in revenue or so, like, the idea is out of the bag, right? And now it's into the sphere of like semi-obvious. And your ability to win that market is execution, right? And that's where a lot of the founder DNA that we try and invest behind comes into play. I would say, like, if I think of some of the ones on our kind of antithesis list, it was a good team, but their initial idea we weren't that compelled by. And then they iterated a lot and came into a better idea after we passed. And then they, went on to have good success and what have you. And that's tough to invest behind. It's hard for us to invest behind a team knowing that their first idea might not not be great and that they're going to figure it out. But we try and push ourselves on that, and I think we really try and not get overly obsessed with the product features of the first product or the mechanics or whatever, but like, is this the team that when they come into hard things, they're going to figure it out, and they're going to iterate there? Because part of the beauty of pre-seed, when you're doing all this iteration before you're really scaling the team and kind of ramping up the burn rate, like that ability to iterate, that's your superpower. Like that is the opportunity, right? And so I think as pre-seed investors, we really need to embrace that. And I think we're that sort of like gets pushed to an extreme is where, we love this team, but are we willing to invest behind an idea that we don't love with the hope that they'll figure it out? And I think that's the line where, our risk appetite tends to get challenged quite a bit.
I think the other thing that's hard with pre-seed is these rounds are generally speaking pretty small. So if someone raises $5 million and I don't love the idea, I'm like, well, we actually have enough money that we can afford to go through one or two iteration cycles to find a better idea. So if this one's like good enough, we're financed for some exploration. If you raise a $1 or $2 million pre-seed round, you might only get your original idea plus one. So if the original one is like not that good, you've already kind of burned up half of your idea life. And I just find it really hard to enthusiastically invest in companies where I don't think the original idea is, at least, as we say, in the zip code of a good idea.
Right on. No, it's great perspective. Really like the example of Stripe demo day. There's a lot of those. I guess just to come back to some of the questions from the audience. One question is around how do you source your deal flow? So like what are the biggest sources of deal flow? Is it like website submissions? Is it introductions from people you know? Like what are the major buckets and chunks of high quality deal flow for Precursor and Baukunst?
I'm happy to go first. So I would separate like total volume from like what gets closed. We get like 200 submissions a week between referrals and the website. The website is like 100 to 150 of the 200. The majority of stuff we do is actually referral, but it's getting actually, this is like a marketing attribution problem we have now, which is increasingly we're having people who submit on the website, but also will then get a warm referral. So we'll go into the CRM and I'm like, oh, this person already submitted. So like who gets credit? I don't know. I don't care. But like increasingly, like we're finding that the channels are getting clogged. But about 40% of the things we end up investing in come directly from referrals from founders that we've either invested in or consider ourselves pretty close to. And then kind of an equal number from our closest co-investors. So that's like 80% of it is like people who know us well.
Right. So 80% is, of investments that you make is from either founders you know well, primarily the portfolio, or co-investors, right? And that's great. And, it's a great endorsement for our, the relationship intelligence side of the platform that we've built at Metal. Those are exactly the things we, prioritize and encourage founders to sort of pursue when looking to get an interaction with investors. Matt, what does that look like for Baukunst in terms of like, high quality deal flow?
Yeah, sure. So at Baukunst, we have a group we call the Baukunst Collective, which is a highly curated group of about 200 individuals who are former operators, friends of the firm, people we backed before. And we have special programming and things we do for that group. That drives about half of our deal flow that come through that network. So that's a very kind of well-oiled machine that we maintain. Probably another like 30% or so come from kind of warm relationships, other people we have in our network, whether it's other investors or other folks that we backed before, what have you. But we still continue to have like a pretty, healthy part of our deals that we close from people where we have zero existing relationship or connection, and they'll come through the website. They'll find us on social media. We've closed a couple deals that we've sourced through my partner Kate's TikTok channel. We've done other things like that. And I think for a pre-seed investor, that is just like an incredibly crucial part of our funnel, even though it's not 90% of the deals we do or whatever. But like our opportunity as pre-seed investors are like finding those founders who don't yet have a network, who don't yet have financial means, who don't yet have the ability to like really take the leap and do all those traditional things. So like that for us is just a huge part of the prize, is to find those perspectives and back those founders and seek out channels where they can get to us. So everything that comes with the website, we do have someone review. It might not always feel like that, from the outside. But we really take that seriously, and we really are intentional about making sure that however people want to reach us, that we can at least get into the funnel and get eyes on it within the firm, and get back to them at some point. It's not always 24 hours, but we do try and make an effort to get back to them at some point.
Right. We'll take a few more questions from the audience, and then as we approach the end here. So one question here is, sometimes, if there's a founder who's bootstrapped to Series A, and if they're flexible on valuations, Precursor, are these sort of investors still like a good fit, particularly for your case, right? Like if companies like doing, let's say $1 million in analyzed revenue, but they haven't raised any capital, right? Like how would you look at that? Is it too late, or is that more interesting, or?
Our guide rails are usually around check size and valuation. So if it meets those criteria, great. And if not, like no big deal. If it's too late for us, that's fine. So we've backed companies that, yeah, probably got to maybe a little south of $1 million when we invested, which is a little unusual, but not unheard of. The quality of that revenue, you want to take a look at it, and all those obvious things. But yeah, we don't really think about the kind of Series A labels and some other things at this stage. It's really more around how much they're raising and what the valuation is.
Right. Awesome. Charles, would you agree from your perspective, or would you look at differently for,
I think that's right. I think increasingly labels are really hard to interpret. I've had people tell me they're raising a $20 million pre-seed, and I'm like, I don't like it's what you say it is. So we tend to focus on our pre-seed rounds are generally speaking like $1.5 million or less, and seeds that are like 4 to 5 or less. We keep an exceptions bucket because I have friends who are repeat founders who sadly for me will not raise on the terms that are core to us. They're going to raise on better terms because they have more access to capital and the repeat founders. And given the choice of like not participating in their companies or having a small 10% allowance for the fund that can do things on pricing terms and like round structures that don't fit the main model has been a helpful addition. But 90% of the stuff, it's like pre-seed and seed well below 20 post. And the pre-seeds are usually in the single digit post.
Right. Awesome. Well, we have a question here from which is anonymous question. What would you advise a founder that is receiving all these no's? Would you recommend them to go back to join another startup and learn, or keep iterating, or something else? I think this goes back to Charles, your observation around how strange, or how non-obvious or strange some of these legendary companies often seem to be, when they're in the earliest stages, and how, a lot of because some of the, best companies that have come out of Silicon Valley were not, ones that had an easy time fundraising early on. And so I guess just continuing on that sort of thread, if you're a founder, right, or if you, have a portfolio of founders receiving like all these no's, right, from all these investors, right, like let's say a couple dozen no's from 30 investor calls, like, what would you recommend?
So from my experience, there's kind of like two schools of thought on this. And one school of thought says, just talk to as many investors as you can. And it's a big ocean. And eventually you'll find one who has the same vision and believes and ends up investing. And go through hundreds, and whatever it takes, you just have to keep going, keep going, keep going. And the other school of thought is be a little more deliberate and really try and get as much feedback as you can. And we very much fall in or I very much fall in the latter camp, which is like pick a couple of investors who maybe are like your first priority, maybe are like your first priority -1, and pitch 4 or 5 of them, not 20 or 30 of them, and then pause and like see what comes back, reflect, iterate, and use that as a point to really, one, not blow through all your investor introductions, because I think that's can become slippery really quickly. And then, kind of words out that you're fundraising and it starts to become stale, and you lose some of that momentum. But I also think like it's very rare that people get a killer pitch the first time, and I think it really takes a lot of reflection, iterating with other founders, getting other feedback to really hone that. So I'm much more of the, give it kind of discrete chunks. And maybe if you're really, you know, getting some consistent feedback, then you need whatever, a little more business traction or that co-founder you've been looking for, whatever, like, but don't really try and brute force your way through it, because I think it can be really tough to recover, because you can go through a big list of investors pretty quickly if you're not careful.
Right. No, excellent thoughts. I'll add some stuff to that as well. But Charles, would love to hear from you first.
Yeah,
I think
but also,
that's
sorry to just there are those stories you hear of whatever famous, multi-billion-dollar company now that got 1,000 no's, and then the one yes was the company that put them in business. So maybe there's validity to both models, but time will tell. Sorry, go ahead, Charles.
I always just think like, are people telling you things that are easy to address or hard to address? And to Matt's point, if someone's like, hey, you don't have a technical co-founder, that's something you can actually go off and address as a founder. Whether you agree with the feedback or not, you're like, that's actionable. If someone just says, I don't think there's any demand for this product, and investors constantly say that, then like you have to decide, like, if you just believe it, like you can keep going. And this is the thing I've learned as much, like some founders are just going to keep going no matter what I tell them. And so like my decision to say yes or no has like no bearing on their desire to keep going. But for founders in our portfolio, I often tell them like, hey, if most of the stuff that we're hearing back is existential, how do we make those things feel less existential? Like, oh, this company really requires a partnership with A, B, and C company, and if we can't get a partnership with A, B, and C company, the business doesn't work. I'm like, okay, well, either how do we get closer to that partnership or remove that partnership as a dependency? And if we can't do either, then maybe you shouldn't work on the business. But I don't think as a VC, I can tell people to quit. I think I can like provide them with input and perspective, but it's really like the founder's decision about whether they want to keep going.
Right, right. And I mean, I think the connecting tissue here between, everything I'm hearing is like on one end, you want to listen intently, right? And you want to see what's coming your way, and is there a way to iterate on that feedback? Is there a way to work on that feedback? Is there a way to learn from what signal you're getting from the market? And on the other end, like eh, if you don't have conviction in what you're doing, don't fundraise. If you have conviction in what you're doing, then don't lose that conviction because someone else sees the world a different way. Right? Like it's you've got to know what boat you're in, and if you're in the high conviction boat, then like trust yourself and sort of keep going and iterate and find that capital and whatever it takes. And I think this we've seen with so many of these companies that were not investor favorites early on. So points well taken. I guess yeah, I mean this is we hear this a lot. Typically pre-seed, what range of ownership, what's target ownership, right? Is there like a defined sort of range there for your firms? Is it more flexible? What is the right sort of target ownership for Precursor and Baukunst?
We have a range of ownership. I mean, it depends on, how the deals come together and a number of other variables. But I think for us, like we are a very ownership centric fund. And I think for a lot of the founders we work with, that's what they want. They don't love piecing together a cap table that has 10 different, VC investors who all have a very small amount of ownership. They want someone who's going to really show up and do the work and stick their neck out, and really kind of earn that biggest place on the cap table after the founding team. So that's what we focus on. And it does end up being, it can be 10, 20 higher, percent ownership depending on the deal. But that's something that the different funds feel differently on. But for us, I think as a lead investor fund, ends up being quite important.
I think for us, it's a little different. We don't normally lead or take board seats. We'll occasionally lead pre-seed rounds, but we rarely take board seats. We're normally in the 5 to 10 range on pre-seed. So enough for a fund of our size that when the company's successful, we'll do well, but not so much that we can't bring other folks into the syndicate. And then for the seed deals, we're probably more like 3 to 5% because we're not ownership based, our check sort of stays the same size. We just end up with less ownership, if that makes sense.
Right. No, makes sense. Pretty common in pre-seed. We have one question here that I think is interesting. This is from Ahmed from Second Blood. Charles, you said a no is often true, but not the full truth. What are the most useful patterns founders can look for across multiple no's to figure out what's actually driving that, or is like to the extent that you can read into investor rejections, are there patterns that make something very obvious that founders should keep an eye on?
I do think I would, when people ask me this question, I usually say, like, let's focus on things where you can actually improve. And to Matt's point, like, there are parts about your storytelling and deck that you can improve with time. I do find sometimes, particularly in this environment, people don't do a great job talking about the competitive landscape and how things work, or they have naive assumptions about why the biggest companies in their category are successful or what their strategies are. And so I think if people are like not getting the market and your role in the market, that is usually something that you can workshop and improve from a storytelling standpoint. I tell them all the time, like, the people are unlikely to change. So if people don't like your team or don't think your team is great, like you're probably not going to change that in the context of your fundraise. The other thing I will say is sometimes people are asking for an amount of money that the market doesn't believe they can handle or raise. So sometimes people will just say, hey, like, you're raising 5 million. I think you'd be better off with 1 million. I don't know what the right answer is, but I think usually that's a sign that people are telling you that there are parts about the business that aren't sufficiently thought through or fleshed out. And without that being true, you're not a good candidate for a big round. So I'd say like round size and maybe market structure are the two that you could improve on.
Right. Awesome. I think that's great. Any final questions from the audience here? I have one last thing on mind, and this is directly tied to, investor rejections. So, one of the big things, with venture rounds is you will inevitably end up talking to a lot of investors. I think there's some like crazy statistics out there on like, YC companies or other companies backed by top tier accelerators talking to like 80 investors or 60 investors, right? And they end up closing like 5, so it's like, 90% of your investor calls will not, end up with, checks. And that's just the nature of fundraising. What does that look like on the investor side, right? So like if you speak with like, 100 companies in over a 2-month period, or your firm speaks with 100 companies over a 2-month period, what percentage of that is actually, are companies that you either invest in or, get close to investing in?
For companies where we take a second call and really like commit to doing some work, it's about we invest in 1 for every 100 of those that we do, roughly, across 4 partners. And we do about 12 deals a year. So sometimes it's more than a second call, but ones where we really are taking a serious look, it's about 1%.
And that's after the second call, right? Great.
Yeah, roughly. Yeah, roughly. Because we get a lot of ones where it's a first call and then you don't really do much work on it. But for the ones we're really seriously considering, it's about 1%.
Awesome. And Charles, totally understand if there's like specific numbers or non-public, but directionally,
it's about the same. It's if other things that are like qualified and serious, it's probably 1%. That feels about right. 1 in 100.
Awesome. Well, I guess, the reason I wanted to close with that was because, a lot of founders, as we can tell from the questions as well, like are leaning heavily into investor rejections. It's ultimately, either investors see the vision and they're excited about it, right? Or they don't, right? And just like developer payments, Stripe, YC demoed it, decade ago, like a lot of people didn't see it, right? And so it's just, it's not necessarily a reflection of the founder or the company. And I think that's and I think this is like very well articulated in most investor rejection emails, right? Like it's not you or your company, it's just like our views on, things. Um, awesome. Any final thoughts, Charles, Matt, before we wrap up here?
I think you hit the
Awesome.
highlights.
Matt, thank you
Yeah,
so
this
much.
was great.
Charles.
It's a fun topic to dive into. We kind of joke as VCs that like our job is saying no all day. So it's good to spend a little more time digging into what that means.
Right. No, absolutely. I think it's conversations like these that, help sort of bring founders closer to the investor perspective and what's, happening on the other side. Matt is evidence that you can be a very nice person and still say no a lot of times. Well, guys, thank you so much for your time, Charles, Matt. This has been a pleasure. It's a great session. We will share clips and we'll, hopefully do more of these. Thank you again for sharing the, wisdom of your roles and all the things that you have seen and learned in the industry, and we'll keep doing these. Thank you so much for joining.
Great. Thanks for having me.